Hello, good afternoon, good morning. Welcome to the FX Week Ahead live market analysis with myself, Giles Coghlan. Now, this is a very interesting week. We have some very interesting data points coming up, particularly starting tomorrow with the US CPI print. So I'm going to be outlining a good potential trade opportunity that I'm really interested in. And we'll be running through potential ways to trade it, what to look for, as well as keeping on top of the big picture. In markets like these, we've got to be on top of the big picture. What's driving the market? What is the key narrative we need to be on top of? And how do we make sure that we're on the right side of any major moves? Now, very warm welcome to you, Alejandro. Great to have you. CN, lovely to have you back. Philip, Victory, Yasser, good to have you as always. And don't forget, I will be in Dubai at the end of September. So if anyone's around and you're from Dubai and maybe you've come to one of my seminars before, I'm back. Great news after COVID for so long. And I'm really looking forward to sharing lots more different insights that I have on current market dynamics, as well as some more general technical points. If you have any problems hearing my screen in my voice, hi Philip, just let me know. Otherwise, don't forget, as we look at different entries, exits, the whole idea of this webinar is not that it's a signal trading service. You look over my shoulder, you see how someone from a professional trading background goes about making trading decisions. What we're looking at today. So first of all, the workshop on Wednesday, I'll be drilling into the trade for the Australian labour data. We'll be looking most likely at the Aussie New Zealand dollar pair. We've got a couple of data points, one for the Aussie, one for the New Zealand dollar. This is the age of FX coming up. We're going to see most likely some more FX moves as central banks differ in terms of their interest rate moves, and countries differ in terms of their growth expectations. Inflation and growth, the two biggest drivers of currencies. There's a lot of volatility in the mix, so I'm excited about FX markets for the next sort of 6 to 12 months. Week ahead, commodities report. We've got the WASDE report coming out later at 5 o'clock. We'll just quickly remind ourselves of that. The dollar, we'll look at the strength of the dollar, what's been driving it, can it carry on. We'll look at the inflation data coming up on Tuesday, CPI, we'll get ready for that. The Aussie labour data, we'll just be reminding ourselves on the RBA's latest outlook, as well as looking at the dollar yen, gold, silver, and the Japanese yen with the latest potential intervention from the Ministry of Finance, the Bank of Japan, and the FSA from Japan, what to look for, what is trade-worthy and what isn't. So we'll go through everything, looking at the calendar as well as general points on the charts. Don't forget, as always, if you have any questions at any time, put them in the chat box or the question box. There is no question that I consider to be stupid or not worth asking. The only question that is a stupid question is the one you had that didn't ask. Remember, you don't know until you find out. So I'm a big believer in life and in trading, in asking questions, being inquisitive, exploring. That's how we develop, that's how we grow, that's how we expand our knowledge, and that's how we increase our chances against market moves. So bear that in mind, please. The way we're going to start is looking at the economic calendar. Now, what we have coming up, so we've got a Chinese public holiday, and I just want to remind ourselves where we are in markets, have a quick look. We've started on a more risk-on tone today, and the reason we're starting on a risk-on tone, if you just take a look at the 10 and the 2s. Now, this is a very important yield spread. This is the yield spread between the US 10-year yields and the US 2-year yields. It's a very widely followed yield spread. And what this tells us with the 10-year yield is when the 10-year yield rises, the 10-year yield tends to focus on more medium to longer term growth and inflation expectations. So when the 10-year is outpacing the 2 years, it's more positive for medium term US growth. When the 10-year is falling against the 2-year, as it has been for the majority of this year, it means that medium-term growth expectations are falling. Now, that's what we've been having, isn't it, with the US, with concerns that slower, aggressive interest rate hikes is going to make profitability harder for companies, and it's been weighing on equity markets. But now, you see, we're just starting to put a little bit of bottoming in. Yes, we had the yield curve invert, which normally precedes a recession. but we're just seeing a pickup from those lows. So that tells us that some investors are seeing the possibility of a soft landing. Okay, so in other words, the idea of a soft landing is that the Federal Reserve will be able to hike interest rates without crushing growth. And CN makes a great question here. Is there any logic behind recent US dollar weakness? Yes, there is. And the logic, now I was expecting US dollar weakness from the end of last week, and I was looking at long pound US dollar, long euro US dollar for a very specific reason. And we're just going to deal with CN's question now because it's a good one. Now, if you just take a look at the major pairs, what you see is that as of the end of last week and today, we've seen the dollar just tracking lower. Okay, that's obviously been boosting the pound. Pound we expected to move higher after that Liz Truss announcement, UK energy deal, just relieving some of the worst recession fears of a big energy bill for UK consumers and businesses to face. That bill has been capped, subsidized by the UK government for 2 years. Big relief for the pound. Euro US dollar tracking higher on this dollar weakness. Now the dollar weakness is for this reason here. Right? Now, just as we've been seeing more positive expectations of growth, on Tuesday, CN, we have US inflation data. Now, the US inflation headline print is due to fall again. So this is the second consecutive months of falling, to go from 8.5 to 8.1. Now, with the headline falling, that will take the pressure off the Federal Reserve needing to hike interest rates. So if the Federal Reserve don't need to hike interest rates so quickly, it means that 10-year yields can fall lower. It means that the dollar will weaken because aggressive Federal Reserve interest rate expectations start to get priced out. So because we forecast a lower reading, that's why we've seen dollar weakness heading into the event. Now, is this worth chasing now? No. So this is not a time to go long pound US dollar, long euro US dollar on this data. It was really at the end of last week in expectations. And if you look technically in the pound and the euro, you can see you've just moved up to a key technical area. So likely to see a sort of pause in the moves ahead of the actual decision. We'll get on to the decision, but that's why we've had dollar weakness over the last sort of 48, 72 hours. And it's in line with the Fed being able to have a potential soft landing. And look at equities. Of course, if the Fed doesn't have to hike interest rates so quickly, that means equity markets can push higher, right? And so we've seen equity markets push up higher. Also, we have positive sentiment out of Europe, with Ukraine able to push back Russia's forces into a much further back position than had been anticipated, and they've been much more successful. So as a consequence, that was, very, very important. Boosting equity markets. Is it worth chasing? No, but it's still positive. China's quiet because it's the autumn festival for Monday, but expect equity futures markets to open higher overnight for sure. Now, commodities boosting higher on the positive sentiment. Silver. We've been pointing out silver. Silver and gold have both been gaining on the weak dollar, because remember they're paired against the dollar. So a weak dollar lifting both silver and gold. Silver outperforming gold. Remember, we've said on a number of different occasions the gold-silver ratio is very high. So we'd expect silver to outperform gold. We can see that that's happening now. Not one to chase. I'll show you how to trade silver and gold potentially on the CPI print tomorrow. Bonds pretty much sideways, but still expectations of a more aggressive Fed hiking, and the dollar pushing lower, just lifting the majors as expected. Briefly, let's look at the yen. Now, the yen is at a 20-year low, and the reason for the weakness in the Japanese yen has been the fact that 10-year yields have been pushing up so high. Now, if you look here, let's just make this onto the weekly chart, a bit easier to read. You can see that when yields rise, that weakens the yen. So strengthening US 10-year yields, green, weakening yen. So as 10-year yields keep pushing higher, that is weakening the yen. Now, there's been comment after comment by the Bank of Japan, by Japanese officials, and there's also been a meeting of the three groups that need to meet to address yen weakness, which is the Ministry of Finance, the MOF, the Bank of Japan, BOJ, and the FSA. When those three meet, they can decide whether to intervene. Now, they're not going to want to intervene against the yen weakness. Why? Because it's all on the US rates. They'll be waiting to see if the US does something. Now, they did intervene against the yen weakness where the yen was very weak in the 80s. And the Bank of Japan, they intervened, and you know what? They failed. And if you look back through recent history, I can't think of a central bank that has succeeded in defending their currency. The Swiss National Bank tried for years and failed in 2015. The RBNZ tried and failed. The People's Bank of China didn't even attempt to defend the US dollar Chinese yuan 7 region. There was rumors they were thinking about it, but I am certain that they looked at their history books and said, look, when you fight the market, you tend to lose. If the Swiss National Bank, with all their huge gold reserves and their unlimited buying of euros and dollars, if they couldn't prop up the Swiss franc, then, you know, who can do it? Oh, Russia. Good point, CN. Yes. But Russia, you see, and this is the difference, CN, is Russia really, the ruble has been boosted, what by? Prices of oil, okay? So really, it's been the energy markets that have boosted the ruble. So, and this is helpful, CN, thank you for this. If there's, you know, if you did a diagram, can a central bank prop up a currency against wider market forces? There was a squawk on the Russia situation, perfect timings here. But if Russia, you know, had to fight the market, so energy markets were going really low, could they win then? No, right? So you make a good point. I stand corrected. Thank you very much. Russia and the ruble is a modern day contradiction to what I've said, but the point of clarification, which is very helpful, is if the broader market is against you, don't fight it. So that's what's happening with the yen. The broader market, i.e. US rate differentials pushing higher, favors continued yen weakness. That's why the Bank of Japan don't just step in and address this, because I know they're fighting such a big force that they may not be able to win. But with all that being said, okay, should the Bank of Japan intervene and do in coordination with the US and start to strengthen the yen, look for dollar yen downside, euro yen downside. They would be really good opportunities. They would be big scalps that I would be looking for, and typically you'd expect them to move significantly lower, so be aware of that potential. Well, with that being said, let's get stuck into the calendar, because yeah, China puts sand in the wheels. Yes, it does. Capital controls re-exporters by Russia. Yeah, thank you, CN. Sand in the wheels is a good description. Okay, so let's look at Monday, quiet. So I'm not getting involved in any trades today. There's just nothing really going on. We've got a couple of ECB speakers. What are the ECB going to say? Anything sort of more aggressive on interest rate hikes, anything hinting the terminal rate may need to move higher should support the euro. But euro US dollar, a bit more upside, possibly not worth chasing in my opinion, because we've got this big data point coming later in the session, US inflation. Now we've got UK employment data, but it's likely to be eclipsed by US inflation data. If we got a big miss on UK employment, say unemployment came in above 4%, and say the employment change came in negative, then I would expect some downside in the pound, and I'd look to express that with a euro pound upside for a scalp trade. The best opportunity is likely to come from the US inflation data later in the session. Again, if you do see a scalp trade in the euro pound, be aware that we've also got the German ZEW economic current conditions coming out later. And if that's a beat above market expectations, that could lift the euro. So we've got a miss the UK data. B on German data. Remember, Germany is the driving powerhouse of Europe, so good German data is supportive, but it's been very hard for Germany to avoid, the Eurozone to avoid a recession right now. So you can see even the more positive aspect of the economic sentiment is very low. But anything that's not as bad as expected should lift the euro against the pound. So look at that, particularly if the UK employment data comes in weak. Remember, the Bank of England, they projected that the Bank of England that the UK economy will fall into recession in this fourth quarter, 2022, and will be in a recession for 15 months. Okay, this is the best opportunity for the first half of the week. Inflation headline. If it comes in below 7.8% and the core below 5.8%, expect more dollar weakness, and I would express that with a gold, but I prefer silver long. Silver long or pound US dollar long. Should this come in below 7.9 or below 5.7, there'll be a good scalping opportunity, maybe 40 to 80 points. If this comes in high, so above 8.3% for the headline, and also if it manages to go above 8.5%, then we'd expect dollar to strengthen, and then I'd be looking at something like a silver short or a gold short. The dollar to strengthen and weaken both silver and gold. Anything else? If there is a weak currency that's obvious tomorrow, you could trade dollar strength against the weak currency. So we'll see how it goes. But that's how to trade that. Okay, is pound US dollar a fade after Tuesday's CPI? I think, CN, if the inflation print comes in high and pound US dollar drops, I would fade that, right? Okay, CN says CPI reporting is partially noise in the bigger picture. Yes, partially noise in the bigger picture. So to give credence to what you're saying, CN, some Fed speakers have come out and said, yeah, look, inflation has pulled back a little bit, 8.5%, but it's not a trend. It's not that inflation is definitely peaked. But remember that markets are forward pricing and they like to move quickly, and the front runner moves. So if we see the second consecutive month of falling CPI, expectations will rise that peak inflation is there, the Fed will have to be less aggressive, and we will almost certainly see upside in equity markets and downside in the dollar, which would support pound US dollar, euro US dollar higher, gold higher, silver higher. Definitely worth a scalp. Is it worth a medium-term position? Arguably not, which would give credence to what you're saying, CN, in the bigger picture. But short-term, scalpable opportunities, yes, for sure, it's a good opportunity. Wednesday, we come into UK inflation data. Now, with the energy price boost and the price cap on energy bills for UK consumers and businesses, it's unlikely that UK inflation will hit that 13% target that the Bank of England hit in the last, projected in the last interest rate meeting. But similarly, inflation is a focus in the UK, and if inflation can drop lower, okay, say it comes in, 9.6%, 9.7%, that will mean the UK will need to be less aggressive in hiking interest rates. Now, I could see that counterintuitively boosting the pound. Why? Because it means stagflation risk is a lot lower, okay? So watch out for a counterintuitive reaction. If we saw a low CPI print, that could boost the pound further. So look out for potential pound strength on CPI miss and a beat. Just be aware of that for Wednesday. I could see some relief in the pound if we see inflation pulling back. More Eurozone speakers, and we got some PPI data. Remember, this is the producer price index, so this just gives an indication of what pricing is doing for producers in the US. Similarly, same tradable outlook to the CPI print that we have for the PPI print. So low PPI should be supportive for less aggressive Fed hikes, downside in dollar, upside in equities. Overnight, we've got the New Zealand GDP growth rate. that's quite important. RBNZ has been pretty focused on the strong resilience of New Zealand's economy. But if we start to see GDP sharply dropping lower, then we could see some New Zealand dollar weakness against the Aussie. Remember, and we'll look at this on Wednesday, the potential trading opportunity I'd be looking for is a divergence between the New Zealand data and the Aussie data. Australia, the last RBA rate meeting. And remember, if you ever want to know what a central bank's doing, just go along to my blog here at blog.hycmlab.com, and almost every central bank, pretty much every central bank meeting, right, I cover. And you can just go to Central Bank Watch and you can just see, you know, the RBA. And I tell you what happened and I give you the full RBA statement, right? And so you can see here, look, Australia is focused on the labour market being strong and recognising unemployment rate the lowest has been for 50 years at 3.4% for July. So the labour jobs missed in the middle of August was only seen as a blip in an otherwise healthy trend. The RBA expects some increase in unemployment as economic growth slows and recognises the full force of higher interest rates has not yet made its way into mortgage payments. So that tells you, okay, in other words, they're expecting this to fall a little bit, so it will be a big surprise. If there's a big fall, it could surprise the RBA, right? And so you might see some more Australian dollar downside, particularly against the New Zealand dollar, particularly if this is a big beat. So that's how you trade that. We'll look into it in detail on Wednesday, looking for those short-term tradable opportunities. Don't forget, we've got the WASDE report today. That's important for commodities, particularly soybeans and wheat, depending on how the weather patterns are looking for the harvest periods coming up in South America. So check that out if you're a commodities trader. US retail sales is always important to gauge the health of the US consumer. If the US consumer is doing well, that's generally a boost and an expectation for US growth. 70% of the US earnings comes through salaries, and if retail sales are good, then that is a good precursor for general economic growth. So retail sales is important. Friday, we've got inflation expectations and consumer sentiment. Very important for getting the sense of how consumers are feeling. What are they thinking about the current rate of inflation? How are they feeling about future purchases? A lot of traders and economists really like this Michigan consumer sentiment data because it's more sensitive to a slowdown in the US economy than, say, businesses are. And that's because households tend to, you know, bring in their expenditure much more quickly than the business. You know, a business might take some time slowing down, cutting jobs, cutting costs. It maybe can afford to do so. A household, and particularly because it's more, you know, it may be one household, maybe based on one or two incomes, any perceived slowdown in income will quickly result in a shift in sentiment. So if US Michigan sentiment remains strong, then expect expectations to continue for a Fed soft landing, particularly if the CPI print is a miss. So if CPI print is a miss on Tuesday and the Michigan consumer sentiment is good, then there's more chance of a soft landing from the Fed. So you expect equity markets to track higher through the week. You expect the dollar to track higher, lower through the week. Expect commodities to continue to push up. So there's a real opportunity for some more risk-on trading. But is it so obvious that you want to just buy into the risk? No way. We have to be nimble in these markets. And so that's why, and this is in line with like CN's comment, you know, and it's a good point that CN makes. It's hang on, Giles, hang on. This is, in the bigger picture, this is just noise. And it is right. But when you look at the recent data we've had out of the US, we can see that in the last few weeks, we have had a pretty good run, right? So if you look from July through to, let's look there, and we just look at the US, All right, let me just bear with me. Let's get rid of that. Well, you see, we have had a pretty decent run of some US data. So the ISM data was good. We had good jobs print, a couple of strong jobs prints. So my calendar's being a bit slow here. Let's hope it comes in. Okay, calendar's playing up, so please excuse me. But just if you notice from the start of September, jobs data pretty good. 215,000, decent on the headline print. Average earnings down, which is good, showing inflation pressure slightly off the boil. Unemployment slightly higher, but nothing to really majorly worry about. ISM data pretty strong. Nothing wrong with exports and imports. Malicious jobless claims lower. That's good news. We've, it's been just a decent run of data points that certainly doesn't massively worry. There's a hard landing. CPI down mostly due to recent energy decline. Really a trend. I'll show you what I think is trending for CPI. It's clearly not a trend, right? But it still is the second consecutive month of downfall. And if you look at the break-even inflation rate, what you can see, the break-even inflation rate is due to fall to 1.7% this time next year. So investors are seeing inflation falling down to 1.7%, below the 2% Fed target by this time next year. So investors are seeing a slower inflation coming. Also, if you look at the headline CPI, you can see that it tends to follow the manufacturing and services prices paid composite. And you look at the manufacturing and services prices paid composite, CN, and what you can see is dropping sharply lower. Now, CPI should track the prices paid component as well. Okay, do you see? And then the other little boost you've got is the agriculture and livestock commodity index. So do you see how inflation tends to track agriculture and commodity prices, CN, right? So if you look at it, CPI is high, but what's pulling back now? Agriculture and livestock commodity index. And do you see how CPI tends to track food prices? So what you're saying is CPI down mostly due to recent energy decline. That certainly helps, right? Food prices helps. Prices paid helps. Break-even inflation expectations helps. So it's more than just like pie in the sky here, right? There is more of a case. But nevertheless, what you're saying is still valid. That is this like a definite trend? No. But is it the second consecutive month drop? Yes. Has it been weakening the dollar during these last few sessions? Yes. Was that anticipatable? Yes. So that's the best I can do on that. All these suppressing factors on CPI also affect other major currencies also, not just US dollar, but it's very important for trading the dollar that we're on top of that. This is the best opportunity, and we're likely to see the dollar shift a lot. So, come on, if you're looking at short-term interest rate deviations and opportunities, that is a really good opportunity coming up with the CPI print. So don't miss the wood for the trees here, folks. If this comes in very low, sub 7.9, core sub 5.8, expect media upside, pound US dollar, euro US dollar, upside in gold, upside in silver, upside in equities. If it comes in high, above market expectations, 8.3 up to 8.5%, and for the core over 6.3%. then you'd expect immediate dollar strength, downside gold, downside silver, downside equities, and then I would probably, in terms of currencies, I'd probably take upside in dollar yen. Folks, been an absolute pleasure. Don't forget, Wednesday, we will be back here again, and I will be getting us ready for that potential trade on the Aussie-New Zealand dollar pair. Take care, have a very good week, and I look forward to speaking to you soon. Thanks, everyone. Take care, everyone. Thank you for everything. Yeah, you're welcome, Philip. Thanks, CN. Thank you, Alejandro. Sammy. Bye, folks.